In this video, I finally share my entire dividend portfolio, which most of it I bought during the last few months, employing the strategy I laid in my previous video. So if you haven't watched that, what I currently do is buying dividend stocks which are on the higher yield, about 3 to 6%, not all of them, as you will soon see, when they are undervalued, with the intention of selling them when they reach a fair valuation, and I will demonstrate that extensively in this video. And while waiting for them to reach their fair valuation, I of course enjoy collecting the dividends. And for the stocks that are still trading at a low valuation, at the low price level, and maybe even lower than I bought, I intend to sell naked put options to enhance my returns even more. So in this video, I will show my entire portfolio. So those dividend stocks currently comprise about half of my portfolio, about 50%, while the rest is 20% in cash and 30% more are in value / growth stocks. So I was initially planning on doing another video sharing my entire portfolio, but right now I'm thinking just to skip it and to get to the stock analysis and sharing my my research and my buys and sells on this channel. But if you do want to see my entire portfolio, please comment below so I will know. Currently I will probably skip this one, and from the next video I will already share just my work and my research and my analysis and how do I do with this strategy. So if that interests you, please subscribe and stay tuned. But for now, I will share the 50% that are the dividend stocks. So let's get to it. So I currently have 16 dividend stocks, and I have more stocks that pay dividend, but I didn't buy them for the dividend, and they have a really small yield, so I don't really count them as a dividend stock. So my two biggest positions and my two smallest positions, which I will reveal soon, will not be exactly employing the strategy that I shared in the beginning of this video and in my previous video extensively. But all the middle ones, the 4 to 15, will be. So the first, the largest position in my portfolio is I have a crazy YouTube effect. Ta-da! Douglas Dynamics, which I did an analysis video about. It's a company that manufactures and sells snow handling equipment, like full trucks and attachments, mostly to municipalities and big commercial clients. And currently, Douglas Dynamics is the second largest position in my entire portfolio. Again, if you're curious to see my entire portfolio, let me know in the comments below. So if we go to look in fast graphs, the reason I say that this is not exactly employing the strategy I shared is, first of all, because we see that the earnings are pretty much erratic in Douglas Dynamics history, and that's not exactly what I'm looking for right now. This is a company I bought a few years ago already, and I've made an investment mistake with it. I knew it pretty soon, but it's not the worst one. My mistake was buying it at a fair value, thinking, and maybe it wasn't a bad thinking, at the time their interest rates were still 0, and I was thinking that it's just a safe place to park my money that does give a higher yield. It's not completely wrong. I am currently down 40% on it. My average buying price is $37. Right now it's trading at $27. But this is right now one of my highest conviction investments overall. I talked extensively about it in my video about Douglas Dynamics. But overall, if you believe that snow will come back someday to the northeast of the United States, probably next year or the year after that, Douglas Dynamics will do probably really well, even while there are still problems with the supply chain with chassis. But I think it will do pretty well, and my price target is around $37. Yeah, like here, it's not, so this is at 18 PE. We see that historically it's been trading at an average of a PE of 23, but we see how much that could change. But I think that overall, even if it will not come back to the valuation of 23 PE because interest rates are higher and the valuations of all the dividend stocks have been lower, still I think there is an upside here to be had, especially if we look at the cash flow situation of Douglas Dynamics. We see that, let me remove that. We see that historically it's been trading around a 15 multiple of the cash flow, and we see that there is even more of an upside. And again, $37 is about the fair value, I think, my target price. And when I bought it, I knew, I even wrote to myself that I'm buying it at fair value, so it was $37 then also. So that's I'm saying that from the current price, it's one of my highest convictions plays right now. When I bought it, not that much, but this is around the price that I will sell it. So yeah, my second position, let me do the reveal, is Billerud, which I actually sold this morning because it didn't exactly reach my target price, but I thought that it has already done enough. I was up 20% on it. This is a lumber and packaging company in Sweden. I actually bought the Swedish stock. I got this idea from Wolf Report on Seeking Alpha, which is actually the only one that I know online that I don't know a lot of investors online, but he's the only one that I know that also uses this strategy where he buys dividend stocks when they are undervalued and sells when they reach their fair valuation, when he thinks there is not much of an upside left. I think he used to be much better than he is now, but anyway. So Billerud, I sold it today, and we can see I want to skim over it because I did buy it with the intention of selling it at fair value. But again, we see that the earnings are really erratic for this one, and I think that's not a company I would be buying in the future again. And anyway, I think there is not I don't know if there is much of an upside. We can see that it's really unpredictable. Its earnings could like in the recession, it could go really low, so not a big recommendation now, not that I recommend anything. So that's Billerud. So those were two stocks that I bought a while ago, and not exactly using the strategy. So from now on, the next stocks will be ones that are pretty much new buys for me. And they do represent well the strategy that I have talked about. So my next one is TD, Toronto Dominion Bank, one of the largest banks in Canada, and it has been paying consistent dividend more than 150 years now. They hadn't cut their dividend in at least in 30 years. And this is a stock I have been successful with the strategy already a few times. It has been a few times where I bought it around the $55 mark and sold it towards the $70, $65, $70. So that's what I'm doing now again. And while I wait for it to one day get to there, I collect the 5% dividend yield. So if we look at the Toronto Dominion Bank, now we see the really consistent trend of increasing earnings over the years. And of course, there were a few bumps along the way, like in the financial crisis. So this is not a recession-proof stock, but we see it hasn't been that bad also, only 15%. But anyway, we can see that long-term, the company does manage to grow its earnings, and that's exactly what I'm looking for and talking about with this strategy. And we see that historically, it has been trading at around PE multiple of 12. So, and right now, currently, it's trading trading at around almost 10. So there is definitely an upside here. Of course, earnings could go lower in the next few years, but and it might take some time for it to get to this blue line again. But again, while I wait, I'm collecting this nice 5% dividend, and I will try. I have not been very successful in selling naked puts on TD and the other Canadian bank which I hold, which is a Bank of Nova Scotia. We will get to it. Sometimes the premium is really, really low. It's not even realistic to really sell the put, but I will try. I have been successful a few times. So we can see that the price target, even if I shorten the horizon a little bit, we see that the normal multiple goes lower, but still there is an upside for, oh, this is in Canadian dollars. Let me switch. I hold it in US dollars, so let's look at that. So even, yeah, if we shorten it, we see that there is still an upside to $63. I think it could go even higher. But again, we should remember that interest rates are now higher. And that means that usually the valuations of dividend stocks, which are kind of an alternative to T-bonds and to T-bills and bonds, are trading at lower multiples. But still, I think definitely it will one day get here or here or here, and that's the point where I sell. So maybe I will go a little bit faster on the next ones. So the next stock in my dividend portfolio is Bristol Myers, BMY, one of the big pharma companies, also around 3.7% of my portfolio. I bought it at around $41. Currently it's $49, so I'm already 15% up on it, but of course it could fall tomorrow and I will be at a break even. But if we look at BMY, and that's a little bit more of a tricky one also, because it's not a yeah, the pattern here, there's something fishy about it. It had this really high growth in earnings, and now I think there's a few patent cliffs on the horizon, and the earnings are expected to go lower. And of course, it depends on the pipeline and all the regular stuff with pharma. But we see that the current valuation is really, really low, even in historical terms. Even if I take out the earnings and the normal multiple, just to see on the historical norms, if it just goes to the historical earnings of the last 10 years, we can see it's trading at really low valuation. But currently the earnings are high. Of course, we see this downtrend coming, but still I think it looks very undervalued. And again, while I wait for something to change, I collect this 5% dividend yield. If we look at the cash flow situation, I think it's yeah, we can see it again that the recent years have been really up, but the share price is lower. I might do more of a deep dive. I mean, I did when I bought it, but because I don't record it, I don't remember as much, and that's one of the reasons I started this YouTube channel. So if someone is interested in hearing more of a deep dive on BMY and what exactly is happening here, I would be glad to do that, and I only need the call to action, the push to do that. So please let me know. So this is BMW in Bristol Myers. The next stock in my portfolio is J&J. So I went heavy on pharma. As I said in the previous video, I already sold Roche, which is also a pharma stock, for a 30% gain. So and I will have another pharma on this list soon. So yeah, they seemed all undervalued. You know, sometimes a whole sector is unpopular and unloved, and there are a few opportunities there. I don't want to be too heavy in one sector, but on the other hand, I feel like the sector of pharmaceuticals, they have their own cycles and they have, of course, their own risks, but they're not that sensitive to a recession. So I kind of liked it because the rest of my portfolio, my value and growth stocks are really cyclical, are really sensitive to a recession. So I felt like a few pharma stocks, they are both seem undervalued, as I will show in a minute. And they seem to be a good protection against like a macro recession. So yeah, I kind of went a little bit. It's not too bad. Heavy on the pharma stocks. So J&J. I think they became a full-on pharma stock just a few years ago when they spun off the rest of their business, but this is exactly what I'm talking about, and I gave this one as an example in my video where I explained the strategy also because it's so classical. This is exactly what I mean. We see the really consistent growth in earnings. We see that the price is really tracking the blue line mostly. Of course, we can change the periods, but I think it's gonna be even for different periods, it's still the normal multiple is around 17. So it's just perfect. So yeah, I bought it, let's see, around $145, and it's currently $160 already, and and it's getting close to my price target, which is about $165, $169. We'll see. And I said also that with J&J, I might wait for it to get a little bit over the 17 multiple, over the blue line, because we see that eventually it does. Of course, currently they always project their earnings to grow in the future, but right now we see they are flat, and they have been flat in the last few years. So I'm not counting on this 183, but on this, for example, 172. So we have a little bit of an upside still. I don't know, it doesn't really matter. I might sell it a little bit before, a little bit after, it doesn't matter. And the dividend yield is on the lower range, but we get the quality in return, so that balances it well. And the next stock is UGI Corporation, and this is a gas utility stock. Again, I'm currently focusing on stocks that are kind of recession proof, and again, they have their own risks, big risks, and I'm still, as I explained, not comfortable holding them really long term because of those inherent risks to their sectors and on a company level when they are mature companies, and they might do stupid things just to survive or to show growth. But for the time being, UGI Corporation seems like a nice, safe stock. While there is a higher risk of a recession, so the earnings have been growing long term, not as steadily as Johnson & Johnson, obviously, but we still see a positive trend long term. In recent years, we see a little bit of a down, and now they're forecasting that there will not be a big growth. I mean, if I shorten the horizon here, we see it's pretty much flat right now. But even if it's flat, it's currently trading at a PE of 8, which is really low for a gas utility, and there are definitely risks with it. I mean, there is a reason it's so undervalued, obviously, and what I'm beginning to understand that maybe I will focus more on companies that are not this much undervalued, because usually there is a good reason for it. So with UGI, although the dividend yield is high and it seems really trading at a PE of 8 and it's a utility, there are some current serious risks going with it. If I remember correctly, they did a semi-unsuccessful acquisition of Amerigas, which are currently they're impairing, and it's not clear whether it will go as planned. And they have a huge debt due soon, so they will need to somehow finance it. So there are definitely risks with it, and that's why my position is moderate at best, and maybe I will need to hold it long term to see the upside. But there is a risk of a dividend cut with this one. But even if it's cut like in half, it's still a yield that is nicer than most dividend growth stocks, and it might give an upside to the price where it would be part of their plan of reconstruction and the capital management, which will be more sustainable, so that could give it an upside. If we look at the cash situation, so we see that currently it's also okay, so we'll see with this one. Again, not risks free. So the next stock is BNS, Bank of Nova Scotia, another Canadian bank. I love those two stocks. I have already a few times bought and sold them at those prices, like I said, with TD and BNS. The Bank of Nova Scotia current yield is really high, and if we look again, its earning also pays a dividend over 100 years, a really good track record of paying and increasing dividend. So we see that again, the graph looks really good in terms of increasing earnings. They had a dip in earnings in the recession, but it's not as serious. And of course, it could happen if there is a recession. We might need to wait a few more years for it to recover and get to its fair valuation. But we see that really similar to TD. It was trading historically at around 12 PE. Currently, it's around 9 PE. So even if we look at only 9 years or 7 years, we see it's about a fair value, or it could go a little bit higher. I think also the interest rates are for sure influence in it. So it's around, it might have a little bit of upside, it might not, but it's really, I don't know if it's exactly the strategy I was talking about. I actually bought this one, I think even before I started with it, but it's a really high yield. It seems super safe to me. Again, everything could happen. Even 100 years of dividend could always come to an end. They usually do eventually, but we see there are some risks with it, and obviously there is a reason also it's undervalued. It has a big exposure to Latin America, and if there is a recession, they're gonna suffer. But if we are patient and hold it through, I think eventually we will see an upside here and collect this nice dividend while I wait. And also I'm gonna try soon when I get to it to sell naked puts because I think I'm a little bit down on it currently. I'm down on it, so definitely if it goes even lower, I will want to buy more, so that's a good reason to sell naked puts. If it does go lower, I will gladly be assigned those stocks, and if it doesn't, I will enjoy the premium of the put, so why not? So the next stock is Altria Group. I have to admit it has been a little bit difficult for me to buy a tobacco stock, but eventually it is what it is. Even on the business side of it, it is kind of controversial because it's obviously, we don't see that in this beautiful graph, but obviously tobacco is a declining industry. Currently Altria and BTI, which I also hold, and I will get to it, they manage still to increase their earnings because they do share buybacks and manage to increase prices, but the volumes are going down, and they will eventually have to reinvent themselves with vapes and all kind of stuff. And specifically, I don't want to get into too long of a story. Again, if any stock interests you in particular, let me know, and we'll do a separate video about. But it had also a very unsuccessful successful acquisition of Joule, which went really badly, and currently I think they're writing it off also. If we're looking at basic earnings, yeah, they had to write it off. Oh no, it was long ago. I'm not sure that's the one, but it was just a disaster. But they will probably get through it. This is not my target price at all. If we look just at those few years, like 5 years, yeah, like 7 years, yeah, I think it's already gotten kind of to its fair value. Maybe I should sell it already. I haven't looked at it. I'm up already, just 10% on it. It was higher already. I might sell it soon. I might wait a little bit. It's trading at a PE of 10 right now. Maybe that's a fair value. Maybe that's good enough. Again, I'm up 10% on it. So that's it's not getting to those valuations anytime soon. So yeah. MO, it is what it is. Of course, the dividend yield is super high, but that's not what I'm here for. I mean, I enjoy it, of course, but of course, we need to be wary of stocks that give a really high yield, while there are huge risks of capital losses. So that's about Altria Group. So the next one is SJM, James Macker, a food company, packaged food company, very safe. Again, I'm not sure how recession-proof it is. I have actually recorded a video about Conagra, which I didn't publish, but I was kind of surprised how discretionary those companies are in a recession. If we look at 2008, yeah, we see that its earnings have been growing still, so that's good. But anyway, we see the nice track record of growing earnings it has. So that's exactly fits my strategy really well. And I'm sure that there are currently all the industry faces a few headwinds, like inflationary pressures, which makes consumers spend less, plus they have higher costs, but they also have long-term headwinds in terms of supermarkets, which have their own private labels now, and they're getting the best shelf space in the supermarket. But overall, we see that even if earnings will not grow again, as estimates are estimating, we still, I think, still seems to be a nice upside to it, even to the PE of 15, which is the normal, which is the expected PE. But the normal PE, historical one, is 16, so it might be even more. So yeah, so the price target is around 150, 164, but I'm not swearing by it. We'll see. I mean, currently it seems like there is an upside, even if I shorten it, so it might be a little bit less. But as it goes closer, if it goes closer, I will look at it again, and we'll see what changes in the story, how the estimates are changing, what is the current price. So I will decide when it gets there, but it seems like there is an upside here. And again, while I wait for this gap to close, I enjoy this almost 3.5% dividend yield. I'm currently up 8%, but I think it was like 2% 2 days ago. So yeah, of course it's volatile. So yeah, but if it goes again to my buying price, so maybe I will also sell puts on it. So that would enhance my returns a little bit and compensate me while I wait. So that's SJM. The next one is Hershey's, which I kind of at first decided not to invest in, but then I said, why not? So Hershey's also, it has an amazing track record of growing earnings, and that's what really tempted me. As we can see, again, could be pretty discretionary in a recession. It's for those who don't know, it's a confectionery company of a lot of chocolate and sweets brands, very well-known ones. And we can see that it's historical. The reason why I at first didn't want to invest in it is because it's always trades. It's a really high valuation, and for a company that has been growing about 8%, 7% in all this time period, and if I narrow it down, yeah, it's still 8%. 8%, yeah. So a multiple of 24, I think, is high, really high. The blue line, it seems really high. I would have been more comfortable buying it around the orange line and around a PE of 15, but it's a really high quality company, and there's probably a reason why people mostly are willing to pay more for it. So I'm not betting on those valuations, but I am currently the reason it's down is probably the interest rates also affected it a little bit, but it seems like it's really been going down only lately, now that the estimates see flat earnings. So again, a lot of headwinds in this sector, in all the sectors pretty much right now. The macro is tough, and we see how that affected it in the past also when there was a tough macroeconomics condition. So if we take this track record into account, it will probably resume growth once the markets look better, and then it would probably get this valuation. But I kind of hate betting on it because this valuation is really, really high. But it has been trading around this valuation for 20 years now, so maybe, I don't know, I put a small, this is why I put a small position on it, even though it really looks like a great company, no doubt, really great track record, a nice dividend of less than 3% or less than my threshold, but why not? And there is not a lot of upside, but there is some like 15% upside. Again, I enjoy the dividend. If it goes lower, I might sell put options. So I don't know. It's not the best, but it's the best company. It's not the best opportunity in terms of upside and expected returns. But I kind of tried to balance it. I mean, I took a few big risks with companies like UGI, which have a big dividend yield, a big upside if it turns out well, but a lot of risks. And then on the other side, Hershey's, it's probably on the other side of that spectrum where the yield is low and the upside is low, but it's a really safe company, it seems like. So it's like balancing, again, not the best opportunity. So the next one is BTI, so British American Tobacco, one of the big tobacco companies. So I already talked about MO, Altria Group. So it's pretty much the same story. They don't have that bad track record with the Juul, but it's also, my impression is a little bit of maybe a lower quality company. I just have that impression from my research. But I think it has more, if I remember correctly, it has more upside. Yeah, we definitely see it has more upside, a little bit more. I mean, we saw with Altria, it has already gotten to the blue line. BTI still has a small way to go, maybe like a really small way. Yeah, like a 13% more, but it still has some upside, maybe. Of course, earnings could go a little bit lower, but and the yield is even higher, but somehow I got the impression there are even more risks with it also. So I put a small position in it. It's less than 2% of my portfolio, but I do enjoy the dividend. But I am currently already 13% up on it because I bought it around $31.4, so it's somewhere here. So when I bought it from here to here, I had an upside of 30%, and I knew that. I think I rolled that to myself. So I'm already halfway up. I might, because those companies are risky, I'm not a huge fan of them. I might sell it even earlier. Then again, the dividend is really tempting. I don't want to invest only for the dividend high yield only, maybe just in a few really safe companies like Bank of Nova Scotia or Pfizer or Conagra that I will get to soon, but not this one maybe. So I will probably sell it when it has a little bit more upside, and I will sell it then. So that's BTI. And General Mills, another food company. As you can see, I went heavy with food companies, pharma companies, tobacco companies, all kind of stuff that seem recession-proof to me because, again, because the rest of my portfolio is in heavily cyclical stocks, and there is a higher risk of recession, so I just sleep better with it at night. So General Mills, also a company, I feel it's becoming pretty repetitive, so I'm gonna go through it faster. We also see a great track record that every time it hit around the orange line, maybe not every time, but nearly, when it hit around 15 PE, it was a good buying opportunity because it usually trades around 17 PE, and it could be a difference. And right now we see the earnings flat again because of some headwinds that the industry is facing, inflationary pressures, all that. And we do, I think I am up 8% on it. Again, it has been volatile, but if we look a little bit on the, yeah, it still has a little bit of upside. The dividend yield is currently 3.5%. Yeah, the upside is really small. That's why the position is really small. Also, I know there is not a lot of upside, but it will, again, I think eventually get above the blue line also. I might wait for this with the company like General Mills, with a company like Johnson & Johnson, because they are so stable, and we see that they have been maybe not as beautifully as J&J, but they have been trading around the blue line. So it probably will get there. So I don't know, it just feels like a small upside, a nice dividend, again, on the Hershey's side of the spectrum. So we're getting to the really smaller positions, which are less of, there is a reason there are smaller positions. So the next one is Black Hills Corp, which is also a gas utility. I think UGI is more like a diversified utility. Black Hills Corp, I think, if I remember correctly, is more solely into gas. But if we look at it, yeah, also we see it's not as beautiful track record, not as stable as some of the other companies we have seen, but still a long-term growth we see, at least from 2008, and of course it could hit again a period like that. But we see that since ever it has been trading around the blue line, but there is a lot of volatility here. It's not as clear and as precise as maybe J&J, but still currently it's so undervalued, and we see again flat earnings, even a little bit of a decrease in earnings. So that's probably the reason. There are some risks with it also. The dividend yield is 4.5, but well, let me shorten it a little bit. It does seem it has an upside, definitely, but it has also risks, and that's why I committed only a small position to it. So yeah, so we're getting to the end of it almost. Pfizer. So Pfizer, I did a video about analysis, one of my first videos, not very high quality in terms of production, but I do think I have had some nice insights with it. And my conclusion was that it's pretty much trading at a fair value, and even if it looks like there is an upside because there is some expectation of really increased earnings here, I didn't really realize where those expectations are coming from. I thought that there could be a surprise for the worst in terms of earnings. Again, just from a pretty shallow research, but as we can see, Pfizer is a no-growth company. If we shorten this crazy peak, we all know why that happened. We see it pretty much showed no growth, like 4% and like look at this period, it was really flat. So I think this is the kind of company Pfizer is. I mean, it could always change. It could go, it could start to decline in earnings. There are some patent cliffs in its horizon. So I don't think there is much of an upside in terms of price here. I mean, I don't even want to look at the graph. Yeah, even if I do, there is not a big of an upside. But when I bought it, it was, yeah, I'm a little bit up on it. I think it was a 6% yield, which seemed really sweet for a big pharma stable company like Pfizer. And this and the Conagra, which I will get to in a minute, I thought they were fair value when I bought them, but the dividend yield is high. The companies that are stable seem safe, and I committed a small position to them in this thinking that if it goes down, I buy more. If it goes up, I enjoy it. If it goes sideways, I just collect the dividend. Eventually, it will go up or down. So yeah, really a small position, not a significant one. My next one is a weird one, and this is Café de Coral, which is a food chain. It's like a fast food chain in Hong Kong. They're now expanding to mainland China. I got this idea from the Value Investing Club's website, and I researched it. It looks really, really good, but since I don't, I mean, I learned a lot about this one. It was in the time when I researched a lot the companies, but since it's in Hong Kong and I don't know if I can trust it or not, I put a really small position to it, but it seems it looked really good, and one of my theses for it were that the dividend was cut and it should get increased back, and it did. So now my yield is really high, but it's pretty much probably unsustainable. That looks really ugly, but we see it has been trading at really high valuations historically. Even if I shorten it a little bit, it's not going to change much, of around 40 PE, 35 PE, 30 PE, which is really high. But when I bought it, it was around the price it is now, which is around 13, 14, maybe 14. I'm a bit down on it. Yeah, so maybe 15, 14 PE, which seems really fair for a high growth company. I mean, it's currently it had a few headwinds having to do with some political turmoil in Hong Kong, and COVID, of course, and the lockdowns, but for the price I bought it, I thought it was a good opportunity. I still think so, but it is high risk, and again, because it's in Hong Kong, I don't know. So I put a really small position in it, and they did increase their dividend already, but now it seems really unsustainable. I don't know. Again, really small position, a kind of speculative one. Yeah, so that's Café de Coral. It has a super high yield now, but it's not, I really didn't buy it as a dividend stock. I just thought I have this cushion, but yeah, I think there is some upside to it once it gets back to growth and it implements its strategy of expanding to mainland China. Hopefully it goes well. I don't know. Again, speculative, a small position. And my last one is Conagra, which I kind of already covered while I talked about General Mills and James Smucker, about the packaged food companies, and about Pfizer, when I said that Conagra and Pfizer are the companies I think I bought at fair value, and there isn't much of an upside, but the dividend is nice, and those are pretty safe companies. Again, they could always do stupid things and destroy shareholder value, but we'll see. That's why it's a small position. It does seem like it has a upside here, but I made the case that it really doesn't. Yeah. So that's Conagra, and this is pretty much it. So these stocks, as I've said, currently comprise about half of my portfolio, about 50%, maybe a little bit less now that I sold the Roche and I sold the Bill this morning. So they are yielding currently on this portfolio, on this half of portfolio, just to see my nice pie. About 5.1%, something like that. Of course, I have a few high-yielding stocks, a few on the lower side of the yield in my range of around at least 3%. And I do pay 25% taxes on the dividends. So currently, the dividend income covers about a quarter of our annual expenses, which is already nice. So I strive, I hope that in a few years, the dividends and the capital gains and the extra returns from the premiums of the put options will hopefully cover all our expenses. So that's about it. So yeah, this is my dividend portfolio. I would love to know what you think. Do you hold any of those? Are you bearish on any of those? If you want a deeper analysis on any of those, all I need is the queue, because I would love to do that and get a deeper conviction in them, especially for selling put options. So I plan from the next video to share already analysis of companies and the research I do. I would love to hear your feedback on anything about this video or the other ones. Please write me in the comments, write me an email, anything. And yeah, I'll see you in the next one. Bye bye.